Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And tonight's program, Jun Bei Liu of Tribeca Alpha Plus looks at three companies in particular that she likes right now: Domino's, Dexus, and of course Ramsay, which is a company she's talked about before. And then we've got Mike Gable, and Mike's looking at the charts. Is there any sign within all these charts that says the market's going to head up in the right direction? Certainly, I think looking at the charts today, they're not all that great. So we may well have a bit of a longer waiting period than we like, but Michael does pick out one company in particular he thinks looks really crash hot for the future. And then last Friday, I interviewed Anthony Doyle just after that unbelievable inflation number that led to a crazy surge in the stock market. Anthony explains that, but also underlines how important it will be when that inflation number falls, how the stock market will rebound and set the scene for a strong period of stock market growth in 2023. It's a very, very interesting interview, and he makes some very important revelations. That's the show now. Let's kick off with Jun Bei Liu of Tribeca Alpha Plus, followed by Mike Gable from Fairmont Equities. Well, joining me now is Jun Bei Liu of the Tribeca Alpha Plus Fund, and I want to know how she's playing this market right now. Disappointed of that inflation number in the US last week?
Look, I don't think it was all that surprising, because we talked about this. Things will take time to come through, and if anything, the increase in terms of basket of goods, in terms of price increase, is a little bit less. So it's coming off the the huge increases in previous months. So it is coming off just very, very slowly. I didn't think it was probably warrant a huge rally in the market, and then sort of next day it reverses. But net, I think it's as expected. It's going to take a little bit longer, but it is gradually coming off. And there's one thing though in there, we do have to look into it. A big part of the CPI, I'm not sure if you know this, is the home occupier equivalent rent. Yeah. So it's a theoretical number. So essentially saying people who's bought their house and then assume what sort of rent they will pay if they renting. So it's a theoretical number, and that is something like 30% of the CPI, and that's gone up a lot. A big driver of inflation. Now, so at some point in the future, we all know rent follows those houses prices. We know the house prices started falling in the US because of interest rate increase, and rent is probably usually something between 4 and 6 month sort of delay. And if the market rent started falling, then you can see that theoretical number change quite rapidly.
Yeah, it's going to be very interesting to see. Particularly, I've made reference in the past to Shane Oliver's pipeline of indicators for inflation. And it's been dropping for 4 or 5 months.
That's right.
And the official data is just starting to drop now. We could get a surprise number. If we'd got a surprise number in November or December, would the market really react pretty strongly, do you think?
Absolutely, because right now what market is pricing in, if you look at what market is assuming for the Fed interest rate, ultimate interest rate where it gets to, it's something like 5%. We're crazy. Just not going to get there. So it's clearly an overreaction. There's a pessimism, there's uncertainty, plus China, what's being said over the weekend, bit of disappointment about the zero COVID policies was reiterated,
which is not good for costs and inflation.
Look, it's not good. Yeah. So all of that together, I just seen the market taking a bit of risk out. But net, if anything, there is quite a lot of negativity has been priced in.
Yeah, and when you look at the low levels of growth in China, for the stuff that they are producing, they're not really going to be in a position to be, overpricing, because the world is actually even going to alternative suppliers.
That's right.
In recent times.
That's right. In a way, this is quite interesting that China has its own, restrictive policy. That's why growth has been very tough. So net, it's actually positive in a way for the world, because imagine China was going red hot in terms of economy. What would happen to the inflation numbers? It could be double. It could be double the price, like a double-digit
oil
growth.
In particular.
Exactly. So imagine if that was happening. So what would central banks do? They'll put up the interest rates so rapidly that the most likely will head into a very, very severe recession.
Okay. What have you been buying?
Oh,
Not
lots
shoes.
of things.
We're not talking about
No
shoes.
Yeah, lots of shoes, and but lots of things. A market like this is really, really exciting time for us. Easiest one to buy is that you buy quality growth businesses, quality leaders, the ones that has execution, proven execution over the last many years. Things like Domino's, we talked about it before. It's fallen so far. Yes, I know there potentially will be another downgrade to come because Europe is a bit tough. But look, I don't buy Domino for the more near term, for the next 6-month earnings. And if anything, this company is actually quite strengthened around the world.
And recessions should be good for pizza, not bad.
Oh, absolutely. Yeah, so absolutely. And so you'll prolong that sort of spending on that product. And they just recently, remember, they got the Taiwan, the new region. So that's additional growth. So, I think the company is in better position than it's ever been. So it's been sold off a lot. Was $160 12 months ago. Now it's 55 or less than that.
And it tends historically to rebound out of big sell-offs, doesn't it?
Absolutely, absolutely. So that's why it's easier to find quality growth company to buy during this sell-off, because the valuation D-rate story is pretty much done. Can you imagine the terminal rate to go to 10%? No, we're not going to get there. So I do think there's a lot of pessimism in terms of valuation story, and that's pretty much done. You want to buy these businesses. However, you need to be careful the ones that might have some of the earnings issues. If it's a cyclical, so a lot of US growth NASDAQ company, they're actually consumer tech. So consumer tech, you just have to be a bit careful because they spend a lot of money on goods and stuff over the last few years, and then next few years they're going to spend a little bit less. Doesn't mean it's crashing, but it's just going to a little bit less. And if the earnings going to downgrade over the next couple of years, then this consumer tech will be a little bit tough. But you stick to your healthcare, which can easily buy, where it gives you underpins good growth in the next few years.
So you like CSL these levels?
CSL's good. It's a very reasonable value. Today had an update with Bifo and the existing business pretty much in line with expectations. Just very defensive quality companies.
You can be a courageous buyer at times. What about Linus? Linus is low at the moment. What do you think about Linus?
Look, that's a really interesting point. I do think Linus has a very interesting interesting positioning, particularly when the world is becoming more uncertain and the bifurcation, if you like, or the segregation between the China and the rest of the world, just simply because the demand for the kind of rare earth product is going to be outside China, is going to be more and more and become more and more strategic as well. So given China is the big producer, and then outside that there's really not much else. So and it's very important for future demand of your cell phones and all the consumer goods.
Cell phones are pretty important.
Oh, absolutely. So especially when the world is becoming more strategic about those critical critical material infrastructure, I do think it has a pretty good niche space. Yeah.
Okay, what else do you like at the moment?
Well, I think as the share price goes low, I constantly find anything. One easy one is Ramsay. Ramsay private hospitals, and clearly share price has now fallen way below what even the bid price before the bid price came in. Why
do you think they dropped out on that?
Well,
bid?
because there's a couple of reasons. I actually think the biggest reason is because during the September period, obviously there's a few dollars differential between what board wants for the shareholder as well as what and what KKR are willing to pay, $3-4. But in the scheme of things, very small differential. Now, what's really happened in September was, remember, the bond yield become very volatile and jumped significantly. So in the US, most of the investment banks have now struggled with passing through or syndicating out some of the transitional loans. So normally during M&A deals, investment banks will take on the debt for the company, and then they syndicate out within 2 weeks, a very short-term bridging loan. And then normally it takes a couple of weeks, these are gone. And every month there's about 80 to 90 billion US dollars in the US market for that to move through. And now in September, because the bond yield moves so quickly, all the investment bankers were stuck with a lot of those loans, and they didn't want to take a loss on it because in real economy things are okay. They didn't want to take a loss on it, so it's now taking 6 weeks instead of 2 weeks. And then there's a bit of backlog of that. So literally from then on, we haven't seen any M&A deals just because it's ceased up. It's just that particular part of the market, very niche. It's not real economy. It's just those loan that was written for the thing is now needs a bit of time indigestion to go through the market. The prediction is by early next year, this will clear. And what the investment banker will tell you that they're currently working on like deals across every sector. There's just opportunities everywhere.
So when we get that break on inflation and the market is just revving up for a big rebound.
Oh, absolutely.
The M&A people want to try and get in just before then.
They'll get in as soon as they can get that release or stabilization of the bond yield. Yeah.
And bond yields are actually behaving, as you pointed out, pretty silly at the moment.
Oh, absolutely. Just lack of confidence. I think equity people lack confidence, equity investors, that's why it's jittery. And the bond investors the same at this point, just because they lost so much money so far last 12 months, the bond markets. So they had just been very uncertain at the moment. So you're lacking confidence for people to step in and support and really silly bond yield out there at the moment.
Do you think that if, for example, what we're kind of expecting that inflation eventually drops and then interest rate rises start to dissipate and stop, that will be a good thing for bond fund managers because they've now locked themselves in much higher rates than they were when interest rates started to rise?
Yeah, absolutely. So quite a lot of those fixed income, not that I pay a lot of attention to it, but fixed income actually offering very good yield at the moment with very limited risk, and they look very attractive. But this also translates to parts of the equity market that's a little bit bond-like. So that's why you talk to the growth businesses because they're long duration sort of business. And when that change, when stabilization comes, they will rally very hard.
And people are starting to like REITs again as well.
Yeah, so REITs is another sector. I believe if it stays here, the M&A deals will pretty much buy us half of the sector. They're just too many attractive yield opportunities at the moment.
Do you have a favourite REIT?
I have quite a few, but I think the cheapest one at this point is Dexus. And Dexus is looking incredibly attractive. Big discount to NTA. Premium offices still attract a lot of international investor demand. My view is that a lot of them are willing to buy just, the short-term indigestion of those investment banks' appetite for M&A. It just means they'll probably wait till early next year.
Thanks, Jun Bei Liu.
Thank you very much.
That's Jun Bei Liu from Tribeca Alpha Plus. Welcome back, Michael.
Thanks, Peter.
All right, mate, we've been praying for a good inflation number in the US, but our prayers have not been answered. Do you think all of a sudden we will get a bit of a shock, surprise drop in inflation?
I mean, it's inevitable that inflation will drop. Unfortunately, after last month's CPI numbers, we just have to put it off for another month now and see what happens in next month's numbers. I think a lot of us were expecting the possibility of a good number last week. Obviously, shipping rates, cost of shipping has dropped dramatically. Cost of lumber, oil has gone down, US housing prices. Look, a range of factors suggested that we could have potentially seen a good number. It just didn't happen, so we'll just wait till next month and see if it shows up in next month's figures.
We're a bit like farmers waiting for the drought to break, aren't we?
Yeah, it'll break eventually, but
right. And the market will go up.
Yeah.
Okay, mate. Well, I've asked you to look at a number of key asset price movements. Let's kick off with the S&P 500 because that's the one that will really take off if we can get a decent inflation number.
Yeah, definitely. But unfortunately, at the moment, the US market is still in a downtrend. So I'll point out all the bits I could see on the charts. I'll just stand up here and, if we just have a look at what's happened most recently, not much to get excited about, unfortunately. So, the market fell all the way back to the June lows. We know that it broke under it, tried to bounce. A lot of commentators were saying that this bounce here had a lot to do with the RBA and the fact that we only raised rates 25 basis points. So there was, a bit of excitement was starting to build with some, but I think we might have even spoken around here. I mean, what you need to see generally to get a tradable bounce. I mean, if we just ignore the, whether this is an ultimate low or not. Obviously, along the way, you get these bounces that you can trade. So March, June, And before you get one of those bounces, you usually need a bit of work to get done at the low. So you fall to a low, you bounce, you retest it. That's what we saw here. So you get bounces that you can actually do something with. If you just bounce too sharply, like what we saw in September, it doesn't follow through. It's not sustainable. So this needed to at least give us a higher low. It didn't do that. It fell to a new low. Again, a lot of chatter last Friday that the move last Thursday night in the US, because it was down about 2.5% and ended up higher about 2.5%, rallying on bad news, that was a good sign. But at the end of the day, those CPI numbers weren't very good. So the US is basically, the US market's gone back to where it was on Wednesday. So I don't really like what I'm seeing here. I think it needs to, if this is a low for the time being, we'll probably need to see a bit more right-hand side action, similar to in June, and then we've got some kind of bounce. Otherwise, what we need is a capitulation. So I know a lot of people don't want to see that, but I think there's a possibility that we do see that 10% move down.
What a capitulation means, because a lot of people.
Everyone just starts giving up. Yeah. It's all too hard.
Another big drop, which is the capitulation.
Exactly.
Then the smarties come and say, we're going to buy, and that can turn the market.
Yeah, if this time next week, if the market's down about 10% in a week, and then we get a bounce, I'll be jumping in, ears pinned back, because you usually end up with a pretty solid bounce. Yeah. We'll see what happens.
Yeah.
So,
and data this week's going to be important. There's a September US economic growth number. There's also leading index and industrial production. It's going to be interesting. Data's going to determine what's going to happen to those charts.
Yeah, and that data might give us these sorts of bounces to trade, but I think the ultimate low, going back to I think what I've been saying for several months now, I don't think an ultimate low will be found until the market has less uncertainty, more certainty around what the interest rate rises are. So, either we get a cracking CPI number really low next month or the month after, and the Fed Reserve makes it clear that there's only so many interest rate rises ahead of us. That'll be the ultimate low, the ultimate buying opportunity. Fortunately, after what happened last week, we've got to kick it down another month and see what happens.
I'm looking for Jerome Powell to put on the leather jacket, the brown leather jacket like George W. Bush, and stand on an aircraft carrier and say, mission complete. Yeah. That's when the market will really
just right off in the sunset. We don't have to see him again.
No more interest rate rises. Boom, up goes the, and he can retire. Yeah. All right, let's go to, I guess the Aussie market's not going to be very different.
It's obviously an ugly chart. A lot of these huge drops. I mean, at least our market's had a couple of capitulations along the way. So we had this huge drop here, and obviously a very big bounce. Again, ultimately the market gets back into its downtrend, and again, the downtrend I don't think will be over until we get that, that pivot that everyone's looking for. What can we say about our market? It went back to the June low, it bounced, but it just looks quite precarious.
We're a follow the leader market at this point in time.
Yeah, exactly, and it is a bit of a dangerous market. I mean, you could see 6,400, 71, back to 64. I mean, these sorts of 10% swings, very, very big ranges intraday. Usually what I look for is for those daily ranges to decrease. So I want volatility to really get down. I want the daily ranges to get lower as well, similar to what we saw here. So when things start to settle down, you tend to have a bit more of a safer entry point. I think trying to necessarily buy these, try to trade these V shapes, it's a bit dangerous.
For the courageous.
Yeah.
Let's go to the first company, CSL. Reported pretty well lately, has very positive views about its acquisition. Well, what's the chart saying? It seems to have difficulty breaking 300.
Yeah, I think longer term this is looking very good. So in some ways I think CSL might have dropped off people's radar because since the COVID lows, it hasn't really done anything. So there's been a lot of other stocks, other opportunities out there. But to me, this is a weekly chart we've got here. to me this looks like a big consolidation. So prior to 2020, there was a massive uptrend in CSL. And to me, it just looks like it's consolidating that move. And again, what we're looking at most recently is the daily ranges starting to narrow. So it's starting to settle down. Here, 2020, early 2021, big trading ranges, very volatile. It started to settle down. It's starting to stay at the top half of this trading range. It bottomed in, I think, February it was. Obviously, our market bottomed over here. So it's already out. Now it's starting to outperform the broader index. The ranges, which is a good sign. The ranges are settling down. That's a good sign. Basically, if it breaks to the upside of this blue line, then you've got, because this has gone on for 2 years, you'll have a rally that will last at least several months. It'll be you could see CSL with a 4 in front of it, potentially by the end of next year if it breaks out.
Yeah.
Now, for a bit of precedence, if we go back to 2018, when we had rate hikes, CSL being a growth stock was under pressure. As soon as we got that Fed pivot and they said 2019 will be cutting rates 4 times during the year, not raising rates. In 2019, CSL basically put on about 50%. So it could really get going. It's not necessarily a buy yet. If you want to play safe, just wait for this to resolve. If it breaks up here, then
so once it has a nice breakthrough 300,
it's on. Yeah.
Okay, it's on for young and old, and for technical analysts like you. All right, let's go to Cochlear next. COH.
So in some ways, you might think the chart is similar to CSL, but what I just see here is just a lot more volatility. So Cochlear needs to be calming down, but it's not. I mean, the daily ranges in this thing are amazing. A couple of weeks ago, it was down 5% in one day on no news. To me, it's still very, very vulnerable. And what I've noticed on this weekly chart is it seems to be coming back to these levels here around $190. To be bullish, it needs to be staying away from support, not sitting around support, because
190 being support.
Yeah, exactly. There's a misconception out there that the more you test the support level, the stronger it is. It's actually the opposite. The more you test it, the more likely a stock will break through it. And it's true with resistance to the upside. So if a stock is really struggling to get through an upper level over a long period of time, it doesn't mean that's a strong ceiling. To me, I watch that like a hawk, because once it breaks that level, again, you're off to the races. So with this one, it's not really trading correctly. Again, if we go back a few years or so ago, we could see this trend was beautiful, very nice ranges, just nice sustainable trend, and now it's just become so messy.
Because it's a growth company too, isn't it?
Yeah, but it's for whatever reason, it looks like investors are more happy to buy CSL than Cochlear in this market environment.
And probably Cochlear hasn't got a new story. At least CSL came out with a new story with the acquisition of that Swiss business.
Yeah.
And also we all know that a lot of people wouldn't give blood during the COVID period as well. So there's probably a lot more going for CSL.
Yeah, probably a few more catalysts compared to Cochlear.
Let's go to the next one, and that is Linus.
So again, a bit of a messy chart, very volatile, and to me that means a bit of danger. So look, I'm keeping an eye on this. I know I've traded this one before. It's a great stock to trade. Obviously, Linus, largest rare earths producer outside of China, signing contracts with the US government. It's got the story ahead of it. It's just a case of trying to find the right entry point. To me, this looks like a stock that's likely to get lower. The share price is likely to go lower. If this is a low, it really needs to settle down again. I want to see a bit more right-hand side action here. If we have a look all the way back here in 2021, we could see similar situation, very volatile, but then it started to narrow out. We started to get these higher lows, and I remember trading this breakout. We just don't have that yet here, so we could be patient, worth keeping an eye on, but to me this still looks quite dangerous.
You need more action around that $7.30 mark. convincing one before it takes off. It keeps dropping down a bit.
Yeah, or it might
Remains
even drop back down here into the sixes and then level out.
Okay, let's go to TPG. We know Telstra's had a bit of a good run, and we know Optus is having a few problems. So is TPG looking positive or not? It's terrible.
Yeah, it looks terrible. Yeah. So it's just going down, and I don't see anything that to me indicates that will stop just yet. Obviously, I had this big sell-off here. Yeah. In my opinion, when you see a sell-off like that, you're better off just getting out. I know it's hard. Your stock's down 20%. You're trying to rationalise what it's really about. But I think more times than not, it leads to further downside, even if it's not evident straight away. I mean, it did have a big drop here. It did sort of bounce at one stage, but we could see that the overall trend has been down. So, yeah, look, I don't really have much to add on this.
The only thing that would turn that around would be the announcement that David Teo is coming back.
Yeah, they need something. I mean, with you mentioned the Optus saga, that hasn't helped the share price. I mean, maybe when was it announced here? Perhaps had one day up. Needs to do better than that.
No. Okay, let's go to on that same subject, Telstra.
Yeah, Telstra. I mean, I'm not a fan of the stock. Long term, it's a capital destroyer, isn't it?
Has been. Is it a different beast now?
In terms of the way it's been trading since June, this is a weekly chart. What I've been picking up on is basically it looks like investors are pretty happy to dump it when there's a 4 in front of it. And there is a little bit of buying support around here, around this sort of 380-ish region. So ultimately, as we could see, it's not trending. If we just look back at the last 12 months, it is stuck in this range. I've probably got a bit more of a negative bias in terms of the way it's trading, because when it tried to recover here, that was pretty solid selling. It couldn't get anywhere near the old high, and now it's back down to these levels where it's previously found support. Yeah, it just remains to be seen. If it gets above $4 again, and once again gets a lot of selling pressure, to me that'll be a lot more confirmation that it just won't go much higher than that. So.
I didn't bounce you for the stock that you like, but do you have one at the moment that seems to be heading in the right direction?
Not at the moment, Peter. I think the way the broader market's trading, I'd rather not initiate any new positions at the moment. Unfortunately...
Which is news in its own right when you haven't got one that's...
Yeah, I mean, you might as well just save your capital then. I'd rather wait for the better probability trades. I think the way the market is at the moment, it does drag most stocks with it. So sure, there'll be stocks out there over the next week if the market falls that will go up. But if we're talking 5% of stocks go up, I'd rather shoot for opportunities when that number's a lot higher. So. Yeah, I just want to see how this market resolves itself, and when we've got a bit of that tide behind us. As I showed before on that S&P 500 chart, there were periods so far this year, March, sort of July, where you just had that tide of the market behind you, and it just makes it easier to make money than at the moment.
There's too many headwinds, and you're looking for tailwinds to change your attitude.
Yeah, ultimately, and look, hopefully we've only got a few more months of this. Hopefully, next month CPI numbers are good, and then the month after that, and then we get a movement in interest rates, and 2023 could be fantastic. Well, I think it pretty much will be fantastic. It's just a case of waiting out to then and not losing your shirt.
And one last question on that related issue, because I'm of you, the same point of view. When you see a big sell-off, and the US market's down over 25%, that's pretty well what recessions do to the US stock market on average. But we see after that, there's a big rebound of the market. And so America could be in recession in 2023, but the stock market could be rising.
Yep.
That's not historically unusual, is it?
That's right. It's normal. So the market looks ahead 6 to 12 months.
Yeah.
So and we'll see these headlines. So we'll have headlines about we're in recession. We're in recession, but the share market goes up. It doesn't make sense. It rallies. When you're in recession, usually that's the bottom of the market, and it'll continue. And what gets that rally even more sustainable is the fact you'll get a lot of investors sitting on the sidelines, waiting for good news, waiting for the newspapers to say the economy's okay. But by then the market's already rallied 30, 40%, and then they start coming in because they're realising they're missing out, just as we saw a couple of years ago with COVID, off the lows, and then that just sustains the rally even more.
Yeah. Mike, thanks for joining us.
Thanks, Peter.
Mike Gable from Fairmont Equities. Anthony, thanks for joining us.
Cheers, Peter. Thanks.
Now, we're doing this on Friday, one day after a crazy stock market reaction to an ordinary inflation number in the US. 8.2. It was down a little bit, 8.3, but the experts thought at least a 7.9 there was a chance. But the market went up big time. Were you a bit surprised?
It's one of those crazy sessions overnight. So I was coming in on the bus and reading the AFR article about the market reaction, saying that the market had tanked. I got into my desk and one of the portfolio managers said, how good was the market last night? I said, what are you talking about? I mean, it goes to show you that in the short term, there are very, very short-term factors, such as algorithmic buying, technical buying, hedging activity going on, and they can really dominate market moves in the short term. And I think what we saw last night was the market had actually declined to half its total gain since COVID, and that was a key technical level for a lot of funds to close out their short positions, and you saw a lot of short covering, which resulted in the market rallying significantly, a 5% turnaround.
Because there are normal people watching this. I don't know what you're talking about, short covering and stuff like that. It's just the way it is. We're not going to waste our time explaining that. But the bottom line is sometimes there are sort of technical reasons why people have to buy, even though they might think next week the market could go down. Do you think the market will go down next week?
Oh, well,
Come on, be right.
Next week, I've got no idea. And sometimes it's actually easier to forecast the long run than it is the very short run. There are ways to make money from the equity market going up. When I talk about people being short, they're making money from the market going down. Okay, let me tell you the different way I lead my life. You get on a bus, you read a newspaper. How old is this guy? No, not the baby. It was on an app on my phone. On the phone. Okay. So I forgive you for that. But then, the way I live my life is that, I wake up a lot earlier than you. And I go to my phone straight away and I look to the stocks that I watch and the indexes I watch, and we had Dow. It was green. So my instant thinking was, if that was you, what I saw, what would you have thought? The Dow was up. What would you have thought about the inflation number? Well, today, it is all about bad news is good news. So you would have expected that the inflation number was better than expected. Exactly. The market reacted that way. Yeah, exactly. But what I found fascinating when unlike you, while you're on the bus, I'm watching US business TV, which you can do on the bus with your phone. Yes. And one woman, an expert from one of the leading investment banks, said, you've got to remember that rent, which was a big problem with is old data. Yes. And I think the ABS, the American station, BLS, BLS, they're behind what's really going on in the market now, because it was a September number, wasn't it? Yeah, it's now October. Yeah. And I know Shane Oliver with his AMP pipelines indicate it's been falling for about 3 or 4 months. Yeah. In all your history, you're an economist. You work for a lot of institutions. We often do get that surprise. Eventually, a statistician catches up with what's going on. Yeah, and markets are entirely forward-looking, but we have forward-looking, what we call lead indicators, and we have lagging indicators. Yeah. And the focus on inflation and the unemployment rate, which is where central banks have their focus, is famously a lagging indicator. So you want to be looking at some of those leading indicators like consumer confidence or what house prices are doing and assess where the economy is going from those. Has the Fed got the courage to rely on leading rather than lagging? Because at the moment,
their 0.75% are based on their fear that inflation might stay around for too long. Therefore, they have to overkill. But do you think they could overkill the US into a recession they don't have to have?
Well, interestingly, if you look at how the RBA has reacted relative to the Fed, the Fed probably doesn't have the same sort of conviction that inflation will moderate that the RBA does. And they are so fearful in the US of setting off another huge rally in equity markets because that's the main way that they impact consumer spending. It's via equity markets declining.
The stock market.
Because everyone's on fixed rate mortgages. And guess what they did in COVID? They repriced their fixed rate mortgages at historic lows for 30 years.
They're laughing all the way not to the bank.
Well, higher rates don't impact the average American household. So that's how they like to lower household wealth via that channel, via equity markets.
Okay. So when people say to me, oh, Pete, I've lost 8% or 10% of my portfolio, I don't know whether I can cope with this. I invariably say, well, how much income did you make this year? And they often give me a surprise. Their income was actually quite good. And their loss is really on paper for many of these people because they probably gained 2, 3 for 5 years. Since the coronavirus, they went down, but then they came up and they've gone down again.
Yeah, sure.
Are you suspecting that 2023 will be a rebound year for the stock market, whether it starts late or whatever, but once interest rate rises are over and people are seeing inflation coming down, 7, 6, 5 and whatever, do you think the stock market will rebound nicely?
I think inevitably when there is some sort of certainty that interest rate hikes are coming to an end, that will bode well for investor sentiment and optimism. So today, I looked at investor sentiment numbers out of the US and they're at historic lows for a survey that was initiated in 1986.
Right.
So worse than 1987, worse than the tech crash, worse than the GFC, worse than COVID. That goes to show you how extremely pessimistic investors are. And inevitably, when we've seen investor sentiment this poor, the equity market in the next 12 months has delivered double-digit returns.
So there's a really low number on investment sentiment. You often do see a rebound, don't you?
Well, exactly right. And that goes to show you some of the price action that we saw overnight as well. When everyone is crowded to one side of the boat, inevitably people start to run to the other side and they start to equalise the boat.
Or
level out the boat.
Or tip it over.
Tip it over entirely, exactly.
So this is a really important point then. If you put all this sort of information together, and you've got a global oriented fund for Firetrail, are you buying the dip, or I love this one, selling the rip? Have you come across that before?
Of course, yeah. So
it's pretty new, of course.
Yeah, I mean, global equities are a fantastic asset class for Australian investors to help them deliver on their long-term investment goals and savings goals. And we believe you should be fully invested throughout the cycle. It's so difficult to time turning points. And in many ways, this is a better market to invest in than it was when the market was ripping higher on you and it was expensive. So there are businesses today that you can identify that will give you double-digit returns over the next 5 years, which is our investment time horizon.
But some people, and I bet you even your family members are ringing and say, Anthony, I'm worried about recession. I watch the ABC, I listen to radio, I'm scared. Beijing wants to invade Taiwan. You've got the idiot in Russia, doing terrible things to Ukraine. How can you be so confident that the market will rebound? What do you say to those people?
Well, I look at economic history and stock market history, and if you invested, for example, in global equities, similar statistics for the ASX 200, on a total return basis, capital appreciation plus income, if you extend your time horizon out to 5 years, in terms of monthly observations, an investor has always had a positive return. No matter if you invested the day before the COVID crisis, the day before the GFC, the day before Black Monday in 1987, if you invest on any given day, the market can be up, the market can be down. Exactly. And this is when we talk about, often when markets are in a bull market, people will tell me, oh, I'm a long-term investor, I'm happy to extend my time horizon. Inevitably, when you get those concerns, which are always with us, there are always concerns.
Climbing the wall of worry.
Then that is when investor timelines, they collapse to what's going to happen next week, what's going to happen by Christmas. So you need to really, I mean, we're avoiding companies that have very poor balance sheets. We're avoiding companies that are overexposed to the consumer. It is going to be a far more difficult operating environment, but the good companies, this is a prime time for them to expand market share and maybe even start to think about a bit of M&A for some of their competitors.
Okay, so you got a new ETF.
Yes.
This is a free ad for this guy. Okay? Tell us about your ETF.
So I was down at the ASX on Tuesday ringing the bell. So I can't guarantee that's the end of the bear market, you know, but I was down there ringing the bell. The active ETF, it's an active ETF, so it's
so you select the companies?
Yes, 25 to 35 companies, high conviction, what we call concentrated. The ticker is called S3GO, S3GO.
Okay.
It's called the Firetrail S3 Global Opportunities Fund. And S3 stands for the characteristics we look for in companies before they enter into the portfolio. 2 are financial and 1 is sustainability related. So the financial metrics are, we want sustainable business models, we want sustainable earnings as share prices follow earnings. And on the ESG side, the environmental, social and governance side, we're looking for companies that are helping to make the world better. What we describe as sustainable, positive change.
Company. One classic company, come on.
One company that we own. So one company that we own
that
we love at the moment is a company called Weyerhaeuser. Have you heard of it?
Never.
No.
Weyerhaeuser?
Weyerhaeuser, 120-year-old company, listed on the New York Stock Exchange, headquartered in Seattle, the largest private landowner of forests in the United States. It's a timber REIT.
How long has it been going for?
120 years.
I bet you they love Theodore Roosevelt because he was very good for environment, wasn't he?
Yeah, absolutely. So the big opportunity for Weyerhaeuser, they're a lumber company, but they can begin to sell carbon credits into the US carbon market. The current price of carbon in the US, $12 a tonne. If it reaches, and as we expect it will, $25 a tonne, carbon, Weyerhaeuser actually have a choice to make. Will they keep cutting down the trees? Or will they leave them in the ground and monetize that opportunity? If they stop cutting down trees for lumber, well then the lumber price should appreciate. And saving
costs as well.
Exactly. So that's one company that we really like in our portfolio.
We'll give you an idea. And of course, there's some competition or something as well?
Yes, of course. So in line with the launch of the active ETF, S3GO, on the Australian Stock Exchange, we're offering people the chance to win $2,000 in the fund as well. Of
dollars
units.
Or units?
Units, $2,000 worth of units.
And what's the unit going to sell for anyway?
Pardon?
What will a unit sell for?
Today, $4.20.
Okay.
$4.20.
So you're getting a little less than 500 units.
Yeah, so $2,000, you just put in your details. Visit firetrail.com to enter that competition.
It sounds like an ad, but he is working for nothing, so I've got to give him something. That's Anthony Doyle from Firetrail. And that's the show for tonight. Thanks for joining me. Don't forget, if you want more deeper analysis on the stocks to invest in or the stocks to drop, have a look at switzerreport.com.au. Thanks for joining me. See you on Thursday.